right, I'm pretty sure this is working now. You guys will let me know if it is or if it isn't. I can hear the audio. Okay. I'm just reading what you guys are saying. Yeah, I don't know. I don't know about the audio thing. Why you're hearing it only from one side, but I don't know. It's unusual. I mean, I've never done this on YouTube before, so we'll see. We'll see how this goes. It's you guys are experimenting with me here. Appreciate you guys being here. So let's jump right into it. If oh, okay, hold on, I'm playing. I have myself playing in the background. Okay. Anyways, let's start. I hope you guys have had a chance to do it. If at any point you can't hear me or see me or anything gets weird, just let me know in the chat. Looks like we're good to go. So I hope you guys have done it. Hope you've had a chance to look at it. If you haven't, it's all good. Use the chat to ask whatever questions you want, and that's it. Okay. So let's jump into it. So we have 25 multiple choice questions to do, and then a few of the kind of longer style questions at the end. So question number one. I don't know if there's a little bit of a delay between me and you, but ask your questions, and if you feel like I'm not answering you, there might just be a delay. Okay. Yes, this is going to be uploaded after. If you can't stay for the entire thing, or if you have to, or if you want to watch it again, yeah, it's going to be on my YouTube pretty much right after the session ends. Okay. So question number one. What is the most important purpose of share incentive plans? So this is from kind of the introduction of the course. Share incentive plans are really meant to mitigate the principal agent problem, right? Oh, the microphone's in my face. The principal agent problem, which is when the managers don't kind of work in a way that is in the best interest of the owners. We use incentive. An incentive plan is basically where we pay the managers with shares instead of salaries, right? So if we look at this, I would choose B as the answer to this, to align the interests of managers and shareholders, right? To kind of eliminate the principal agent problem. For question number two, which statement about corporations is correct? So corporations, right? We know that there's sole proprietorships, there are partnerships, and there are corporations. You guys need to know kind of the ins and outs of all that. So double taxation, this is true. Double taxation means that because the corporation is a separate entity, it's going to get taxed on its own. First of all, right? There's a corporate income tax. The government will tax the business, and then the shareholders who are going to take profits out are also going to get taxed. So that's the double taxation. We are getting taxed. The corporation gets taxed once, shareholders gets taxed once as well. So that's the answer, but let's look at the other options. There is no separation of ownership and control. There is, right? So there is complete separation. So a corporation is seen as a completely separate entity. So that's why it's not B. Corporations are taxed at the personal tax rate. This is wrong. They're taxed at the corporate tax rate. Okay. And the business has limited liability. Well, the business, this is tricky. The business itself doesn't have limited liability. The business has unlimited liability. It's the shareholders that have limited liability. So what's wrong here is that this should say the shareholders or the owners. Limited liability means that they're not responsible for the debts of the business, right? So let's say you own shares of Amazon, you're not responsible for the debt of Amazon, right? The most that you can lose is whatever you've invested into that business. That's what we call limited liability. Okay. Which of the following is not a limitation of DDM? Is this chapter 1? Again, I don't. The chapters depend on your textbook. It could be chapter 1 for some schools, chapter 2 for other schools, chapter 3. It's usually the earlier chapters, the introduction chapters. That's where I would place this. Which of the following is not a limitation of the dividend discount model? Not a limitation. Let's go through it. The options. It cannot be applied to firms without dividends. I'm pretty sure that's the answer. So let's look at the other options. It can only be applied to constant growing firms. Now, if you've been looking at your equity chapter, the dividend discount model is when the whole thing, right? Where we're finding the price of a stock based on the dividends, and we're discounting the dividends to find the current price. So the main issue is that, yeah, if a company doesn't pay dividends, you cannot apply the dividend discount model. There are other ways to value the company, of course, but this particular model of using dividends to find the price doesn't work. Take a company like Tesla. Tesla doesn't pay dividends at all. So how would you find the price using the dividend discount model? You couldn't. You'd have to use a different model. So this is a limitation. They're asking you which is not a limitation. It can only be applied to constant growing firms. I don't think that's true. Let's look at the other ones. It cannot be used to value private firms. It can. If a private firm pays dividends, I don't see why. Okay, let's go through the options. It cannot be applied to firms with negative earnings. It cannot be applied to firms with negative earnings. So let's see. Not a limitation. So this is a limitation. It can only be applied to constant growing firms. I don't like this. It cannot be used to value private firms. It cannot be applied to firms with negative earnings. I feel like there's probably, I'm solving this exam for the first time with you guys, so I feel like there might be more than one. Let's see if we can get to the actual answer. What do you guys think? I'm looking at the chat right now while I look up, I've got a few textbooks here that we can look through, but in the meantime, you guys can tell me what you think. So, equity, okay. Okay, so pretty sure I found, so I see 1D, 1A. All right, so according to one book that I'm looking at, the dividend discount model does not work well for private firms. So this is one of the limitations. So it's definitely not C and it's not A. It can only be applied to constant growing firms, or it cannot be applied to firms with negative earnings. The model does not work well for firms that are in distress, firms that are in the process of restructuring, firms involved in acquisitions and okay, so no. The DDM works reasonably well for large corporations in many mature industries with stable profits and an established dividend policy. Not surprising, the DDM does not work well, or is difficult to apply to many resource-based companies which are cyclical in nature. Yeah, so theoretically, B is also one of the limitations. So it says basically that it works well when the companies are growing at a steady and sustainable rate. So we want to have basically a constant growing firm. So B is there. So yeah, if you said D, I agree with D based on my research, based on reading through the textbook. But definitely a deep theory there. Okay, good. You said D, congrats. You got it right. Number 4. Which of the following statements is correct? Correct. When coupon rate is higher than the market rate, remember that market rate is the same thing as the yield, right? So when the coupon rate is higher than the yield, we know that this bond is trading at a premium. I'm not even looking at the options, so I can see here the coupon, that this is wrong. This should say premium. So A is out. When the market rate is higher than the coupon rate, so if the coupon rate is lower than the yield, that's a discount. What does the option say? The option says premium. That's also wrong. If a bond is at a discount, okay, that means this. The coupon rate is less than the current yield. Remember that the current yield is always between the two. That's the trick, right? So if it's at a discount, we know that the coupon rate is lower than the yield. So the coupon rate is actually the lowest. So discount bonds look like this. If you fit the current yield in the middle, okay, the current yield would be smaller than the YTM but greater than the coupon rate. So the coupon rate is less than the current yield. This is true. I like C here. And finally, the current yield is a ratio of the annual coupons divided by par value. It's not par value, it's divided by the price. So that one's out as well. Okay, so I like C as the answer here. Kind of an easy one. Just make sure you don't get confused the way that they word it and they, put coupon rate first or market rate first or yield first. Make sure you know your discount, premium, par. These questions are very easy. Question number 5. A bond is selling at a discount. We just talked about what that means, right? This. The coupon rate is less than the yield. Assume the YTM remains constant as this bond approaches. I'm going to move myself a little bit. I'm just going to put myself there. As this bond gets closer to maturity, its price will do what? I'm not going to answer this question right away. I'm going to look at the chat and see what you guys think, because this is some theory that often gets overlooked. If you've taken my classes, I called it the return to par assumption. So what do you guys think for this answer? I'll probably wait like 10 seconds. I won't wait very long. Okay. All right, so the answer that we tend to gravitate towards is A, right? Because if the YTM remains constant, then why wouldn't the price remain constant? But it's not the case. Remember that the return to par assumption always applies when it comes to bonds. It means that, and I'll use the discount bond as the example. Remember that a discount bond is a bond where the price is less than the face value. So as we approach maturity, which is the end of the bond's life, the price of a bond will always return to par. It'll approach the par value, or it'll approach the face value. So a discount bond that is selling at a price that is below face value will increase over time. Whatever the price is today, it's always going to try to return to the face value over time. So the thing you want to take away here is that, and guys, this is always under the assumption that the YTM remains constant. Okay, everything we're saying doesn't apply if it doesn't. But if the YTM remains constant, discount bonds, the price goes up as we approach maturity. And premium bonds do the opposite. Premium bonds actually lose value. The price falls as we approach maturity. So the answer here is B. Okay, I see a lot of B's in the chat. That's great. A par bond, just to complete the theory, a par bond doesn't change. Par bond remains the same as we approach maturity. It's just the same. If the answer was A, it would have to be a par bond. For the answer to be A, they would have had to say a bond is selling at par. Okay. Question 6. Currently, the interest rate is at an all-time low. Therefore, you expect the interest rates to increase in the near future. Knowing this, which of the following bonds would be least desirable? So for this is a bond sensitivity question. Questions like this are super common. And so they're basically telling you interest rates are expected to rise. So your mind goes to, okay, that means bond prices are going to fall. So C would be premium. I just saw that in the chat. Yeah, so if it were par, it would be this. Discount is this. And then, yeah, premium would be this. So if interest rates are expected to increase, it means bonds are expected to fall. So the least desirable would be the one that's going to fall the most. So this is really a long way of asking you, which of these bonds is the most sensitive to interest rates? The most sensitive bond will fall by the most. So we're looking for long maturities, low coupon rates. Let's start with that. I'm going to cross off, look at A and B, because C and D have 10-year maturity, so they're going to be more sensitive. And I'm also looking for the lowest coupon rates. C and D also have the lowest coupon rate. The problem is now they're tied. So when they're tied, you use the tiebreaker, which is the yield. The lower yield makes a bond more sensitive. And so the answer here is C, because the yield is slightly lower than the other one. Okay, so always use these two first. Those are the ones that matter the most. Use the yield as a tiebreaker. If ever you have a situation like this where there's two that you want to pick from, pick the one that has the lower yield. Okay. All right, so then we've got question number 7. You're considering two perpetuities which are identical in every way, except that the perpetuity A will begin making payments of $1,000 to you 1 year from today, while the other one is going to start paying you 11 years from today. Okay. The present value of perpetuity A minus the present value of perpetuity B is what? Now, to understand the answer to this question, the answer is D, first of all. So if you did choose an answer, the answer is D. But just to understand why it's D, I'm going to give myself some space here. And I'm going to draw it out so you guys can kind of visualize it, right? So perpetuity A is paying you, I think it's $1,000. Yeah, $1,000 a year forever, right? So $1,000 basically starting in year 1 and then continuing kind of forever, right? Year 10, year 11, year 12, forever. That's A. While perpetuity B is the same, okay, except it's only going to start paying you at year 11. So the first payment is here at year 11, and then from that point, it's perpetual as well. So nothing before that. And the question is, what is the difference between their present values? The difference between them is the first 10 years. This one that has nothing, and this one has 10 payments. So then what would you think about this, okay? What would you call 10 payments of $1,000? You would call it an annuity. So the difference between them is a 10-year annuity of $1,000. So my answer here, I chose D. The difference between their present values is the present value of, oh, it's not D, it's C. Is the present value of an annuity paying $1,000. I didn't see the do, it's C. It's not do. It's an ordinary annuity paying $1,000 each year for 10 years. Okay. This is an ordinary annuity. Okay. Question in the chat. Using these rules, we don't need to do long calculation for question 6. You should never be doing calculations for a question like question 6. Anytime they're asking you which is the most sensitive, which is the least sensitive, there are formulas you can use. There's a formula called the duration, but you don't need to do that because if you know your which factors increase sensitivity, you should always be able to pinpoint one that is more sensitive than all the other ones. Okay, this is an intro class. Remember, guys, in a higher level class, sure, those of you that are finance majors are going to learn something called duration, and there's a formula, and you can do that. But in an intro class, we typically just look at these characteristics, and we're able to identify the one that is the most sensitive. Okay, so that's it for 6 and 7. Let's look at question number 8. Use the following two statements to answer this question. Okay. The DDM assumes that common shares are valued according to the present value of their expected future dividends. This is a true statement. That's exactly what the dividend discount model is. And the second one, the DDM argues that selling price at any point, say time n, will equal to the present value of all expected future dividends from period n to infinity. This one's tricky because this one sounds like it's saying the same thing as number 1, but it's not. This is wrong because this should say n plus 1. The dividend discount model says that the price of a stock today is the present value of all future dividends. So if we're looking at the price, say at time n, Pn, well, we're looking at all the dividends starting from n plus 1, the following period. So for example, if you're looking for P0, we always start at D1, right? Think about that formula. You know, the dividend, the constant growth DDM. Why is it that we take D1? Because D1 is a future dividend. We never include D0 in the price. So this is wrong because that should say n plus 1. It's all future dividends starting in the next period. So I like 1, I don't like 2. So I choose B. Let me look at the chat. Using these rules, we don't need to do, okay. Oh, okay. There was a question, but I feel like you took it back. So again, guys, if you have questions, just drop them in the chat. I will see them. Even if I'm answering the next question, I'll just go back and answer your question. Question number 9. You are comparing interest rates on 25-year mortgages in Canada and the United States. Mortgage APRs in the US are quoted with monthly compounding, while mortgage APRs in Canada are quoted with semi-annual compounding, right? So that's something you should know, that the US uses monthly compounding and Canada uses semi-annual. Both have an effective annual rate of 8%. If they both have an effective annual rate of 8%, let's go through the options. The APR quoted on Canadian mortgages must be the same. This is not true. Okay? You could math this one out. Because we have the effective annual rate, and we know that the formula for the effective annual rate is 1 plus the QR or the APR over M to the M minus 1, you could just work and say, okay, well, I know the EAR is 8%, so I can find my APR. I can find my quoted rate. If you did it for the US mortgage, or if you did it for the Canadian mortgage, where's my calculator? You could find the APR. Now, I'm not saying you have to math this one out because I think that it's a little bit time consuming, but you can. I'm going to do it because we're not worried about time right now. So I'm solving this algebraically, and I get an APR of 7.72. This would be the US. And for Canada, I would have done the exact same thing, but using semi-annual compounding. Copy, paste. I don't know why it's not working, but okay. I would use 2 instead of 12. And that equals 8%. So that's times 2. I would get an APR of 7.85. So you see the Canadian one actually has a higher quoted rate. Now, if you did follow along with my course, we talked about this. I gave it in the notes that if you keep the effective annual rate constant and you play with the compounding frequency, right? So if your EAR is constant, as you increase the compounding frequency, you decrease the APR. APR and QR, by the way, some of you guys know it as QR, is the same. This is a concept, and you should know this concept, that as you increase the M, your quoted rate actually falls, assuming your effective annual rate remains constant. So if you know that, then you would know already without having to do the math that the US one would have a lower quoted rate. But here's the proof mathematically, so A is no good. Canadians are paying a higher effective monthly rate. So this one's also false. Oh, hold on, I'm blocking the thing. But this one's also false. I'll explain why. When you have an effective annual rate, guys, that is the same. So let's say you have two effective annual rates that are the same, 8%, 8%. They're going to be the same at every time frame. So if the mortgages have the same effective annual rate, they're going to have the same effective monthly rate, the same effective weekly rate, the same effective quarterly rate. It's the same. So I don't like B either, because it's saying that Canadians are going to have a higher effective monthly rate. They won't. They'll have the same. C, U.S. residents are paying a higher effective monthly rate. Also false based on what I just said. Bye-bye. And D, borrowers are paying the same effective monthly rate in both countries. That's the answer. Okay? So same effective annual means same effective anything. Monthly, daily, weekly, doesn't matter. Okay. I'm going to see if I could just shift this over a little bit more. I just feel like I keep blocking it. There. That's better. All right, so let's move on to question number why am I missing 10 questions? Hold on, let me see what's going on with my PDF. It looks like I'm missing everything from 10 to 17. Did you guys download it from the link that I put? Or are you also missing these questions? Hold on. Oh, okay, yeah, they're just not part of it. Okay, got it. Yeah, they're missing for everybody. Okay, so let's move on then to question 17. So they might have been removed for not being relevant or something. We are missing them too. Yeah, I think they were taken out because they weren't relevant. They're like old questions or something. So let's look at this question here. So this bank currently offers a savings account with an interest rate of 8% compounded semi-annually. Okay, so we have 8%, that's our APR, also called QR, compounded semi-annually, so that's 2 times. They want to offer customers another account with interest compounded monthly. Very common question in an intro class. They want the effective annual rates to be equal. What interest rate should they quote? Okay, so we're going to use our effective annual rate formula starting with the one we have. So we have, and again, the formula I'm using is this, 1 plus APR over M to the M minus 1. So 8 over 2 to the power of 2 minus 1. And we want the other account to have the same effective rate, which means we're going to set it equal, but we're going to solve for the APR with monthly compounding. So you set them equal to each other. Plug in the left-hand side into your calculator, like punch this whole thing into your calculator. So this would be 1.04 squared minus 1. This would be 0.0816. And then algebraically solve for the APR. Now, those of you that kind of look at this and hate the algebra, you need to get comfortable with it because this is a very common question. So we're going to start by adding 1 to get rid of that. All right, so that becomes 1.0816. Then to get rid of the 12, we're going to put that to the power of 1 over 12. That'll get rid of the 12. Okay. Then we'll subtract 1. That'll get rid of that. Then we'll multiply by 12 to get rid of that. So 1.0816 to the power 1 over 12 minus 1 times 12, about 7.87%. So if you put B as your answer, perfect. Now, because this is a common question, and I know that some of you guys really, really love the financial calculator. I do too, by the way. This one in particular can be solved on the financial calculator if you know how to use the interest conversion function. So I'm going to show you how to do that. Okay. So assuming you have a Texas Instrument, if you don't have a Texas Instrument, I can't really help you, and you should probably have one because this is the best financial calculator. If you press second function, number 2, you'll get to the interest conversion tool. NOM, that's your APR. So I'm going to enter 8%. I'll save it by pressing enter. And then if you arrow up, you'll see CY, which is your compounds, your M basically. So the first thing I'm showing you here is how can you find the effective annual rate using your financial calculator? Well, enter your APR as NOM. We're going to enter 2 here as the compounding. Arrow up again and press compute. And you see I got my 8.16. Now, there's a little thing I should say. This calculator can only do effective annual. It's not able to calculate effective monthly and quarterly. It's really just for effective annual, but it's really good for this question. So I got 8.16. And now I'm asking myself, okay, well, what if I change? I'm going to go back down now, okay? What if I change my M, my compounding, to 12? So 12, enter. Down, go back to nominal, APR in other words, and press compute, and you'll get 7.87. So it'll do all this math for you if you know how to navigate that menu, okay? So if you've never used it before, you know, and you're interested in using it, come back to this. It'll be obviously posted on YouTube just after we finish, and go through the steps again with me. But it's really straightforward, guys. Your nominal, enter it, enter your compounding frequency, your M, and then compute your effective. That's if you want to go nominal to effective or APR to effective. Or if you want to go backwards, effective to APR, enter your effective rate, enter your compounding frequency, and compute your APR, compute your nominal. Okay, super quick, super easy. And we could move on. 18. A coupon bond is reported as having an ask price of 113% of the par value in the financial post, which means it has a price of 113% of 1,000. So 113% of 1,000 is 1,130. This is what you would call the quoted price. The last interest was made 61 days ago, the last interest payment, and the coupon rate is 12%. What is the invoice price? Invoice price is another way of saying cash price. Okay, there's many words for it. Invoice price, cash price, dirty price. And the coupon rate is 12%. Okie doke. Now, what they haven't told us is whether or not it pays the coupon annually or semi-annually. And so we're going to assume semi-annual. Why? Because bonds generally pay their coupons semi-annually. And if I don't see anything that tells me not to use semi-annual, I'm just going to use semi-annual. Okay, so the first thing is let's find our coupon payment. So we'll do 1,000. That's the face value times the coupon rate divided by 2. So my coupon payment is $60. Then to find accrued interest is found by taking your coupon payment, multiplying it by the days since the last payment. Again, if you have my notes, right, I gave the formula. It's the coupon payment times the days since the last payment in the numerator. So they actually gave you that. The last interest payment was made 61 days ago. Divided by the days between payments. And now here's why I think they didn't tell us if it's annual or semi-annual, because it doesn't actually matter in this question, and you'll see why. You were not given any dates here. So in the denominator, you would typically put the number of days between 2 coupon payments. So like, for example, if your coupon payment was on December 31st and the next one is on June 30th, you would count the number of days between December 31st and June 30th. But here they never mentioned any coupon dates. So the only thing you can do, so this is what you do in this case. Okay, we're going to backtrack because this is a bit of a sketchy one. We're actually going to solve this as annual. So we're going to say 120, and we'll put 365 days at the bottom. 365. 120 times 61 over 365. The accrued interest is about $20.05. And now the cash price, which I call CP, is the quoted price plus the accrued interest. So $11.30 plus about $20 is $11.50. So the answer is B. So again, the reason I'm doing it this way, guys, I wouldn't like to do it this way. It's because they didn't give me dates. So if on your exam you get asked the cash price and you're not given any dates at all, solve it as an annual bond. Mathematically, right? Solve it as an annual bond. If you are given dates, then you do it the long way, right? Like the book does it, or like I've done it in my lessons, where you use, the exact number of days between coupon payments. So why did I make it 120? For that reason, that I didn't have, I don't have dates. They didn't tell me when the last coupon payment was. Like they would have said something like, the last payment was made on June 30th or something like that. Then I wouldn't have done this. Then I would have done it the right way, which is to actually count the number of days. Other question in the chat: all the TVMs can be solved with the financial other than no. Anything that has a growth rate cannot be solved on your financial calculator. So like growing annuities, growing perpetuities, those cannot be done on the financial calculator. Any type of perpetuity cannot be done on the financial calculator. Really, the only thing the financial calculator can do is annuities, ordinary annuities and annuity due. So like things like mortgages, car loans, those can be done on the financial calculator because they're annuities. But anything else, you have to use a formula. Okay. So that's it for the cash price question. Question number 19. Zigzag Corporation's common stock is selling for $22 in the market. So this is the market price, MP, 22 bucks. Their earnings per share is expected to be $2 next year. So this is EPS 1 because they said next year. And the required rate of return is 12. So that's 12. What is the present value of growth opportunities? PVGO. So to find PVGO, the formula is this. The price today is EPS 1 over K plus PVGO or PVGO. So they told you the price is 22. They told you the EPS is next year is $2. The K is 12%, and you can solve for the present value of growth opportunities. So 22 minus 2 divided by 0.12. This works out to be $5.33. Okay, so if the stock is selling today for $22, 5.33, so $5.33 of that $22 is what you're paying for the future growth of the business. When you buy a stock, you're not just buying the stock for what it's worth today, or for what the business is doing today, but also for what you expect the business to do in the future, right? Like when you're buying Tesla stock, you're not buying it because Tesla is super profitable today. You're buying it also because you expect Tesla to be super profitable in the future. So we can actually isolate that component. So we're paying $5.33 for the expected future growth of the business. Okay, but the main thing is this is the formula for it. All right, question number 20. Fizzy Drinks has just announced a dividend of 80 cents for this year. So this is D0. D0 is 80 cents because they said it's for this year. It's a bit tricky, but I'm going to interpret that as 80 cents as D0 and 835 for next year. So I'm going to say this is 0.835. Dividends are expected to grow at a constant rate indefinitely. What is the current stock price? So if you look at the change here, we could find the growth rate, right? Because they said that dividends are expected to grow at a constant rate. So if I do new minus old over old, so next year's dividend minus this year's dividend over this year's dividend, 0.835 minus 0.8 divided by 0.8. This is about a 4.375% change. So that's our growth rate. And then I can use my my dividend discount constant growth DDM, which is D1 over K minus G. So D1 is 0.835. K is 0.131, and G is 0.04375. So $9.57. Okay, so pretty straightforward question there. Find the G, use the G to find the price. $21. Doubling your interest rate from 4 to 8% reduces the length of time for your money to double by how many years? So essentially we're asking you, how long is it going to take to double your money at 4%? How long is it going to take to double your money at 8%? And then take the difference. So for this, you can use your financial calculators. I suggest you do so you don't have to use logs. So I'm going to start by setting my present value to 1 and my future value to 2. My interest rate is 4 and there is no payment. All right, and if you compute N, you're going to get a certain amount. And then I'll do the exact same thing, but I'll set my IY to 8. And then compute N again. So then I would get -1 PV 2 FV, 4 IY, 0 payment, compute N, about 17. It would take about 17.67 years to double your money if you were earning 8%. And then if you plug in the interest rate is 8 and compute N, it would take you only about 9 years to double your money if you were earning 8% on your money. So the difference between these two is about 9 years. Right? If you do 17.67 minus 9, it's 8.67 years. So it's about 9. Okay. 22. You invested $1,000 at 4% compounded annually. How much interest was earned in year 5? So to answer a question like this, what I would do, because this is a lump sum, right? You're not making any additional payments. I would figure out how much I have at year 4. So I would find my future value at year 4 and then find my future value at year 5. The difference between them is the amount of interest you earned in that 5th year. So to find future value 5, I'm basically doing this. Future value 5 minus future value 4. So I'll do 1,000 times 1.04 to the 5 minus 1,000 times 1.04 to the 4. The formula that I'm using, if you don't recognize it, is future value equals present value multiplied by 1 plus k to the n. K or r, whatever symbol you use for the rate, I use k. So 1,000 times 1.04 to the 5 minus 1,000 times 1.04 to the 4. 46.79. Okay, so that is specifically how much interest you earned in that 5th year. For question 23, the stock of Supergrowth Inc. just paid a dividend of 78 cents. Just paid. That's D0. What is the expected capital gain if the stock is selling for $28.25 today? So that's the price, $28.25. And the required rate of return is 15. So I guess there's 2 ways you can do this. One formula you probably want to know is that the return on a stock is the dividend yield, which is D1 over P0, plus the capital gain yield, which is basically the growth rate. Okay. The other formula you can use to solve this question is the basic DDM, which is P0 equals D1 over K minus G. Both of these are actually the exact same formula, just rearranged. One of them solves for the price and the other one solves for K. But I found that this one is really useful on exams with questions like this. So let's see, we have D0. So I know that D1 is D0 multiplied by 1 plus G. So let's start to put it together. All right, so if I were to use, I guess whichever one you use, you're going to have to do a bit of math. So let's say we use this one. We're saying K, which is 15%, equals D0, which is 0.78, times 1 plus G, over P0, which is 28.25, plus G. I'm going to give myself a little bit more room here. So there. And now we're going to try and solve this algebraically. So I would start by bringing the G over. So I get 0.15 minus G equals 0.78. I'm going to expand this to 0.78 plus 0.78 G over 28.25. Then I'll cross multiply this into this. So 28.25 times 0.15 is 4.2375 minus 28.25 G equals 0.78 plus 0.78 G. And then we just group our like terms. So bring that here and bring this here. So 4.2375 minus 0.78 is 3.4575. And then 0.78 plus 28.25 is 29.03 G. Divide this by 29.03. Okay, so I got 11.91%. Let's see if that's one of the options. Hopefully it is. Yeah, B. Okay, so this is how I would solve this question using my required rate of return. Okay. 24. A preferred stock will pay a dividend of $2.75 in the upcoming year. Now, preferred stocks, remember, will pay a constant dividend. So if it's $2.75 in the upcoming year, it's going to be $2.75 every year forever. Right, and so on. This is a perpetuity. The required return is 10%. What is the price of the stock? This is an easy one, right? The present value of a perpetuity is just payment over K. So we're going to do 2.75 divided by 10%, which is 27.50. Okay, preferred stocks, always treat them as ordinary perpetuities. So payment over K, dividend over K, whatever. All right, question number 25. Gianni invested at $10,000 at a rate of 6% compounded annually. How long will it take for the investment to grow to $40,000? So we're going to set our present value to $10,000 and our future value to $40,000. The IY is 6. There is no payment. Compute N. So 10,000, 40,000, 6, 0 payment, compute N. Okay, good. Compute N. 23.79, so D. Okay, so I'm going to freeze here for a second to see if anyone has any questions from the multiple choice section of this, exam. In a moment, we're going to go over to the longer answer questions and work through those. So I'll give you about a minute here. Any questions about it? Which formula can we use for 25? Now, if you don't want to use, you can do this by hand. It would be this formula. So it'd be future value equals present value multiplied by 1 plus your rate to the n. And you'd plug in all the same things, right? So your future value is 40,000. Your present value is 10,000. Your rate is 6, and you're solving for n. But then you have to use logs to solve it, like ln, right? So you have to divide the side by 10,000. So it'd be 4 equals 1.06 n. And then you'd have to use log. So log 4 equals n times log 1.06. And then you do log 4 divided by log 1.06. And that should give you 23.79. So if you don't mind the logs, I do. I just don't like them. But they're totally fine if you don't mind them. Lump sum formula. Yeah, exactly. That's what I did. Whenever there's no payment, it's just a lump sum. Okay. So let's get into these questions here. So please answer the questions below. Be sure to show all your work, blah, blah, blah. Okay. Question number 1. A 15-year bond. By the way, if you have done it, put your answers in the chat. Like, in the chat, say A this, B this, C this. I'm just curious for those of you that actually did it, what you got. Okay. And I'll look at it as I'm solving it. So a 15-year bond with a 10 years to maturity, $1,000 face value and semi-annual coupons was issued at par 3 years ago. You bought this bond 1 year ago when the yield was 12. Okay. How much did you pay for the bond? So let's see. It was issued at par. And it had a 10-year yield. A 15-year bond with a 10-year yield. So what I know is at issuance, because they said it's at par, at issuance, the coupon rate was equal to the YTM. Okay, this is at issuance. It doesn't mean it's still at par. And that's one thing that you guys have to know about bonds, that we don't have long answers on the midterm. Some do, right? So I still put them in here for students that do have long answer questions. Some students at some schools do, some students at other schools don't. But even if you don't, you still need to be able to answer these questions, right? I can make this a multiple choice question by giving you 4 options. Okay, so don't skip them. So just because the bond was at par at issuance doesn't mean it's not going to be at par. It doesn't mean it's always going to stay at par, right? But what I can gather is that the coupon rate must be 10%, right? Because if the yield was 10% when the bond was issued, then I know that the coupon rate is 10% because of this, because they said at par. Today, that bond is not yielding 10% anymore. Today, that bond is yielding 12%. So what you, or not today, rather, I guess last year when you bought it, that bond was yielding 12%. So we're going to start by finding the coupon. So the coupon on this bond would be a face value times coupon rate divided by 2 because it's a semi-annual bond, so 50. And we're going to set that as our payment on the financial calculator. 1,000 is your future value. That's your face value. You're going to use an IY of 6 because the IY, the K basically, is the YTM divided by M. So in this case, that's 12 divided by 2, so 6. And what else are we missing here? N. So a 15-year bond that was issued 3 years ago, but you bought it last year. So you always have to figure out how many payments are remaining at that moment that you're interested. So if I'm interested in the bond last year, that means that this bond, 2 years had passed. So at that point, it was a 13-year bond. When you bought this bond, it was a 13-year bond. Therefore, there were 26 payments remaining. Always use the remaining time for the bond. And then you compute the price. So compute present value. Okay, so 50 is the payment, 1,000 is the future value, 6 IY, 26N compute PV. You would have paid $869.97 for this bond last year. So this is A. B, if the yield to maturity is 10% 3 years from now, what will be the value of the bond? You do not lift a calculator for this question, right? Use your brains. If the yield to maturity is 10%, the bond is at par again, which means the price would be $1,000. Any time that the bond has the coupon rate equal to the yield, the bond is at par. So bonds could start off at par, then trade at a premium, then trade at a discount, then trade at par again, then trade at a discount, all depending on what the interest rates in the market are doing, right? So here the answer to B is 1,000 because they're saying if the coupon rate is equal to the yield, the bond will be at par. And then C, if you are going to sell the bond in 3 years, so I guess you're selling it for 1,000 after having owned it for 4 years, what is your capital gain or loss yield? Okay, so for C, we're going to do P1 minus P0 over P0. P1 is the price you paid, is the price you're selling it for, right? So your selling price. And P0 is the price you bought it for. We'll call that the purchase price. So if you sell it for $1,000, but you bought it for $869.97, then your capital gain yield is 69.97 divided by 869.97. And we're going to multiply that by 100, 14.95%. You made a 14.95% capital gain. Okay, so let me zoom out a bit. Answer to A, we said 869. Answer to B is 1,000. Answer to C, about just under 15%, 14.95%. Okay. Cool. Number 2. ABC Inc. just paid a dividend of $4. Just paid. So that makes this D0. An analyst forecasts the annual dividend of growth of 9% for the next 5 years. Okay, so let's take a look at this on a timeline. For the next 5 years, it's going to be growing at 9%. Then the dividends will decrease by 1% per year in perpetuity. So then after that, the growth rate will become negative 1%, and that will continue on perpetually. So I'm going to split it right here. The required rate of return is 8%, so there's your K. What is the current value of the stock? What is P0? So what you have here is 2 parts. You have a growing annuity on the left, and you have a growing perpetuity on the right. Even though it's shrinking, we're calling it a growing perpetuity because that's the formula. Super common question. There has never been an exam in any school where they tested equity and they didn't ask a question just like this one. Okay, so you better be good at it. So we're going to start by finding the first payment of each section of your timeline. For each cash flow, you need the first payment. So I'm going to need D1, and then and this is 0, 3, 4, 5, and 6. I'm going to need D1 and D6. I don't need any other payments. So D1 is just D0 times 1 plus G. So that'll be $4 times 1.09, which, if I'm good, is 4.36. But let's check 4.1. Yeah, good. Then I want D6. You need to be comfortable finding a future dividend very quickly. Like, I don't want you to sit there and have to do D1, D2, D3, D4, D5 just so you can get to D6. So here's how you do it. Start with whichever one you have. I have D0. And then look at your timeline. Between D0 and D6, the first thing that happens is it's going to grow by 9% 5 times. So I'm going to do times 1 plus the first growth rate to the power of 5. And then that's going to grow by another and then that's going to, well, it's not going to grow, I guess this time. It's going to shrink. But basically, I'm going to do times 1 plus the second growth rate to the power 1. And I can go in one shot from any dividend to any dividend. And then I'm just going to plug in my numbers, right? So this is $4 times 1.09 to the 5 times 1 minus 1% to the 1. And that'll be D6 in one shot. So 4 times 1.09 to the 5 times 0.99, 6.09, that's fine, 6.09. So start by finding your, I'm just going to plug in my camera before it dies. Start by finding the first dividend, the first payment of every section of your cash flow, okay? Now, the reason I like to identify this is, I'm not scattered looking for formulas. Like, there are so many formulas for calculating the present value that if you don't really take the time to identify what you're doing, you're bound to make a mistake, because you might just pick the wrong one. Lump sums, annuities, annuity due, growing, blah, 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 right? But if you write it out, growing annuity, there's only one formula for that. Growing perpetuity, there's only one formula for that. So the present value of a growing annuity is PMT1 over K minus G, multiplied by 1 minus 1 plus G over 1 plus K to the N. Growing perpetuity, there's only one. Present value equals PMT1 over K minus G. Let's start with the left, okay? It's really important that you guys are good with this relationship. That whatever payment you plug into, you are finding the present value one period before. If you took my class, I said it a million times, the present value is one period before the first payment, right? That's what this formula is trying to tell me. So I know that if I plug in D1, I'm going to find P0. So if I plug in D1, 4.36, I'll be finding PV0. The K they said was 8%. The G is 9%. 1 minus 1 plus G over 1 plus K. And then N, you have 5 payments here. The annuity has 5 payments. So 4.36 divided by 0.08 minus 0.09 times 1 minus bracket 1.09 divided by 1.08, 8, close bracket, to the power 5. PV0 is 20.56. Now, this is not my answer. This is half my answer. What I found was that at time 0, the present value of the first 4 payments is $20.56. Okay, I'm going to do the same thing with the other half and then put them all together. But now, look, the same relationship exists here, right? Whatever payment I use, I'm going to find the PV1 period before. So because this starts at D6, you're basically doing this. You're going to find PV5 because I'm going to plug in D6 or PMT6 over K minus G. So look, 6.09 over K minus G, and now G is negative, so just careful with that double negative at the bottom, minus G. PV5 is 6.09 divided by that, 67.67. If you have the habit of labeling, you are not going to accidentally do something like, oh, let me add the two together now. That would be wrong. You're not done here. This now becomes a future value because you're looking for the price today. So you're going to lump sum this back. This becomes your future value, and you're going to lump sum it back to time 0. Divided by 1.08 to the 5, 46.05. I'm just finding the present value of that. And now, because they're both at the same point in time, you add them together. So the answer to this question is 20.56 plus 46.05. 66.61. Assuming I didn't mistype on the calculator, which I feel like I did not. Maybe I did though. 4.36 divided by. Okay, times 1 minus 1.09 divided by 1.08 to the power 5. 2056. This is the only one I was not sure about, but Yeah, see, there it is. So this is how I solve these questions. Split it up, deal with one side as if the other side doesn't exist. That way you don't get overwhelmed by like, my God, there's so much going on. Deal with one side as if the other side doesn't exist. Then deal with the other side as if the other side doesn't exist. And then when you're done, put them all together. Okay. Re-explain the last price again. When I added the two together, you mean? Or... which part do you want me to... I think there's a delay. That's why I'm waiting. The last part. Okay, so I'm just going to explain this part again. So I found the present value 5 by using this formula. But because I want the price today is present value 0. So once you find PV5, you then need to bring it back to times 0. The reason this is PV5 is because I used D6 in my formula. And the formula is basically PV0 is found if you use PMT1, right? The formula, the constant growth DDM, maybe you recognize it better if I write it like that. D1 over K minus G is P0, right? This formula, we've all seen it a million times. Well, if I change D1 to say D6, well, then it becomes P5 equals D6 over K minus G. And then you always have the second step then. Once you find your P5, I'm going to bring it back to P0 by using a lump sum. All right, the formula here is future value over 1 plus K to the N equals present value. Okay. And then, yeah, once they're all back times 0, you put them together and you're done. Can I explain amortization problem with the financial calculator? I think maybe we have one here, don't we? I'll explain it with this question. I'm assuming you mean the amortization function on the financial calculator. I can explain it using this question. So this is our last question, I think. Yep. So below you will find interest rates for RBC. You have a 5-year. Can you explain why we always need to go back to time 0? Time 0 is today, right? So if I ask you the current value, that means the price today. Time 0 represents today. Right, so these are two different mortgages, one with a term of 5 years, one with a term of 25 years. These are the APRs. RBC calculates monthly payments using a 25-year amortization regardless of the term. The term of the mortgage simply refers to the length of period in which the interest rate is fixed. Jane and John Doe want to buy a house in Montreal for $400K. They have $100,000 in savings that they can use as a down payment. They will plan to borrow the rest. 1, what is the monthly payment on a 5-year term? Okay, you absolutely guys have to know how to do this. This is super common. So the first thing would be how much do they borrow? The home costs $400K, but they're going to put a $100,000 down payment, which means they're borrowing the difference, right? They're borrowing $400K minus $100K. They're going to borrow $300,000. That's your present value. The N on a mortgage is based on the amortization period, not the term. Be careful. Even though it says a 5-year term, your N is based on 25 years, and they're paying monthly, so we're multiplying that by 12. So there are 300 payments in total. For the interest rate, there's two ways to do this. You can use CY and PY, or you could not use CY, PY. I'm not going to. Instead, I'm going to find my effective rate. So here, we know that in Canada, mortgages are compounded semi-annually, and they're paid monthly. So I'm going to find my effective rate. I'll do 1 plus the APR. So on the 5-year term, the APR is 5.39, so 0.0539 over M to the m over f minus 1. I'm going to write out the formula that I'm using. 1 plus APR over m to the m over f minus 1. This is how you find your effective rate, basically. Divided by 2 to the power 2 over 12. Oops. Minus 1. So I get 0.004442, which I'm going to multiply by 100 because the IY should always be entered as a percentage. So 0.4442%. Okay. Future value always 0 when you're trying to find the payment, and then you compute the payment. So put this here. 300,000 is your present value. 300 is your N. 0.4442 IY. 0 future value. Compute payment. 1,812.00. Now again, depending on how many decimals you keep on your rate, maybe you get a slightly different answer. But you should be, I used quite a few decimals, so our answer should be pretty much the same. So my mortgage payment here would be about $1,812. For question 2, what will be the outstanding principal balance at the end of the mortgage term of 5 years? So there are a few ways to answer this question. I'm going to show you 2. Both involve the financial calculator. One of them is using just your basic functions here, okay? If you want to find the balance, how much you owe. Okay, so the principal balance, right, is how much we owe. So how much do I owe after 5 years? What you need to do is set your N to the number of payments remaining. So if this started off as a 25-year mortgage, but 5 years have passed, then at this point, there would be 20 years left. 20 times 12 is 240. Everything else is the same. Your IY, keep it as 0.4442. Your future value, keep it as 0. And your payment, leave it as 1812. And then compute your present value. That would be one way to do it. So I'm going to leave my payment as 1812. But I'll change my N to 240 and compute the present value. And I get 267,121 and about 45 cents. Okay, so anytime you want to find the balance, if that's all you're looking for, the balance, take the number of payments remaining, set that as your N, compute PV. The other way to do it, and the way that I actually prefer, is using the amortization function on your calculator because it can do so much more than just the balance. All right, so if you've never used the amortization function, you'll learn how to do it right now. It's very simple. But the first step to use, to use amort, which is what the calculator calls it, step 1 is find your payment. Okay, so we just did that, but we're going to have to restart because I messed it up. So if I wanted to recalculate my payment, I would do everything I did in the first step. So all that good stuff, calculate the 300N, compute payment. I would get my payment. Then go into the amortization. So you're going to press second PV. All right, so second amort. And then your P1 and P2, you have to figure out based on the question. So if we want to know the balance at the end of the term, which payment is that? You have to think about which payment that would be. The end of the term of 5 years, if you're making monthly payments, would be payment 60, right? So you're going to enter P1 as 60. Enter always to save it. And then arrow down, enter P2 also as 60. And essentially what you're telling the calculator is you're giving it a range. You're saying, I only want information about the 60th payment. Not the 59th, not the 61st, just the 60th. That's why we're saying 60 and 60. And then, here, I'll do it at the same time as I'm talking. All right, so second amort, 60 and 60. And then if you arrow down once, you see your balance. right? Which is the answer, 267, 120, 145. What did we have? We had exactly that. But what's cool about this is if you go down again, that's your principal portion of the 60th payment. So on the 60th payment specifically, you paid $622 in principal. And if you go down once more, you find the interest portion. So these are all common questions, right? What is the principal portion? What is the interest portion of like the 32nd payment or the 17th payment? You would find all of those using the amortization function on the calculator. Okay. I have videos on YouTube that go over this. Like for those of you that really want to know the ins and outs of your calculator, I have a video on YouTube called like how to use your financial calculator. It's like a 30-minute, I mean, at this point, I don't know how close you are to your exam, but you know, I go through all the cool tricks on the financial calculator, so you can look at that. But this is one that I think everybody should know. Okay. So that's it. That's how you use it. All right. So this is done. Now I'm going to linger a little bit to answer. If you guys have a couple of questions, you can put them in the chat. If you don't, I mean, you can always reach out to me by email, john@prof.johnk, or better yet, my preferred mode of conversation, which is Instagram. So you can message me there at prof.johnk. But yeah, if you do have any last little questions about what we did here, feel free to drop them in the chat. Also, don't forget to subscribe. Thanks. Right, I think if you click somewhere right around here. Okay. Okay, well, appreciate you guys. Good luck. Whenever your exam is, whatever school you may go to, good luck. And if you guys want more of these, you could check out, I have a bunch on my site, bunch of practice exams. You guys can do more mocks. They're all pre-recorded, so you can watch them at your pace, do them whenever you want. Hit me up with questions anytime. Don't be shy. Is this going to be recorded? Yeah, as soon as this ends, YouTube will just process it and post it on my YouTube. So you can come back here and watch it. Okay, come back to my channel, subscribe, you'll see it, and you'll be able to watch it. All right. All right, everyone. Good luck. How do I end this thing?